This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at how water scarcity across the globe is impacting a range of industries.
Plus, is Apple really the front runner when it comes to Gen Z's preferred devices?
But first, U.S. utilities that lowered their CO2 intensity generated 54% higher returns than sector laggards. And that's according to some BI research. Let's get the detail from the guy behind the research, Bloomberg Intelligence Senior ESG Climate Analyst Andrew John Stevenson. This is amazing because if we can actually track performance and returns to some kind of ESG commitment, that's kind of what the market is missing. Walk us through what your findings are.
Sure. I mean, especially in the utility industry where they're very much aligned. The utility industry itself is very much aligned with making more money. And the easiest way for them to make more money is to spend more on things like renewables, very heavy upfront CapEx like renewables and transmission. And that delivers, ultimately better performance for the investors. But what we did here was we basically created a new data set, which allowed us to look at emissions intensity, which is really the amount of CO2 that's emitted per kilowatt of output for each of the companies on a monthly basis over time. So basically combining two very big government data sources into one to create this metric, and then applied it to the U.S. utility sector, which is about 40 companies, and then broke them up into the top half, the leaders in the space, which are the ones that are emitting the least amount of CO2 per kilowatt of output, and comparing that to the laggards, and found a really striking performance, as you said, over 50% outperformance over the last 4 years, which is very much aligned with, better governance as well as better environmental outputs.
All right. So at the utility level, the plant level, what's working out there? How are they doing it?
So, there's a lot of shifting that's going on, a lot of, obviously, for the very, very kind of coal-heavy companies. They're seeing a lot of retirements in that space. That's sort of freeing them up to invest in renewables and other things going forward. But overall, the United States, utility sector has done reasonably well when it comes to actually driving down their emissions intensities with some of the stronger ones, really competitive and well below what's going on in Europe. So we're really seeing a lot of investment in renewables, which obviously is next to zero emissions and really helps drive down the overall average.
What are the names? What are the names that are doing it right?
Sure. So NextEra obviously is a leader in the space. They're basically everywhere in terms of their generation. They're doing wind, they're doing solar, they're doing it in nearly every state in the country. Dominion's also doing a fantastic job, not just they have new nuclear that's come online, which certainly helps, but also with their investments outside of their general area. And so those are the kind of companies that are seeing really decent uplifts from the fact that they're spending more for what is good for the climate and also good for their bottom line.
So this stuff is expensive, switching over from maybe a coal-powered plant to solar or wind or something like that. What's the return on invested capital that these companies are getting? I mean, do they feel like they're getting a good return here for shareholders? I know you said the stock prices do well, but how about from a return perspective?
Yeah, sure. So, I mean, if you have a coal plant, you are looking at only costs, right? You've already... Most coal plants are over 30 years old. You're not getting any amortization value from them. You basically spend money on maintenance, which you don't get paid for. That's a pass-through cost, and fuel, which you also don't get paid for. That's a pass-through cost. So if you think about from their perspective, they like to spend money and make money, right? They get the guarantee, the rate recovery is around 10, 11%. It's kind of climbing at the moment, but it's still pretty strong. And steady over a very long period of time for these investments. And so upfront CapEx-heavy investments where you're really paying for everything at one time. You're basically paying for the fuel when you make a wind turbine, or you're buying the fuel when you put a solar panel on the market. You're getting paid for all of that. And so it's very much aligned with better governance, better business practices overall. It's a winner for these companies, and even coal-heavy companies like Consumer Energy are starting to see this is a path forward. We can retire these old plants, replace them with heavy capex spending to get us into the renewable space, and make a good return for investors.
Quickly before I let you go, is there another reason why these kind of utilities or companies could have actually outperformed on a total return basis?
Well, obviously, COVID is a very messy piece of business, right? So it's very hard to determine how that affected the overall utility sector. But by and large, the formula of having more capex of your capex going to things where you're getting paid and less of it going to things where you're not getting paid seems to be the strongest driver.
Andrew, thanks a lot. Andrew John Stevenson, we really appreciate it. Bloomberg Intelligence Senior ESG Climate Analyst.
All right, let's turn now to water, where scarcity across the globe is impacting a range of industries. For more, we're joined by Bloomberg Intelligence Senior ESG Integration Analyst Gail Glazerman. Gail, thanks so much for joining us here. Somebody recently, within the last several years, said to me the next war is not going to be fought over oil, it's going to be fought over water. Talk to us about where we are in the global water situation, if you will. Kind of where are the real challenges out there?
I'd say one of the bigger ones that's been in the news the last couple of weeks is out in the West, where states are trying to decide how to allocate water in the Colorado River.
Yep.
And there's some really, really tough choices that get involved when you have to make those types of decisions. And as you look forward to a climate that's going to get continually warmer and drier, it's only going to become more challenging. And so you're looking at real trade-offs between agriculture, business, homes.
Based on that, can I ask a really dumb question? I live in an apartment building in Brooklyn. How do normal people get their water for somebody who lives in a house?
I don't know if there is a normal. I'd say a lot it's a utility that is provided and organized and accountable to the government, but there are places that will have wells, which is going to be a whole different story, going dry.
But I can choose to pay for I'm going to pay for my water, but I'm not going to pay for my cable bill. That happens.
That does happen. I mean, so some of the stories when you think about what happened in Jackson, Mississippi, is that they weren't even getting water, but we're still getting utility bills related to the water. And then there are some businesses that just get the water and are able to take it as a natural resource and don't necessarily have the incentive to control their water use the way they should. But then when that water's not there, that starts becoming a problem. So I think you're starting to see those bills ratchet up.
Well, it's interesting. In your report, you've got a chart of some of the cities that are water risk cities. No kidding. Phoenix, Dallas, Austin, San Antonio. You go out west, there's no water. In reality, what is a intermediate to longer term plan for this country to fund all the growth in some of those markets that you just don't see any water?
It's not an easy decision. So one of the things that put this on my radar for this year is there were stories a couple of weeks ago about a small community in Arizona near Scottsdale that was getting their water from Scottsdale, and Scottsdale realized we're running short for our own citizens and we're not going to give you water anymore. And you think through the consequences of that is you've got homes where replacing that water could cost as much as a mortgage, which then if you're holding that mortgage, you've got a lot of consequences. And you have home builders that have made investments in acquiring water rights.
Yep.
Those are going to go up and be more expensive. You may have to take impairments on some assets that you've built if you had a plan to build 1,000 homes, but there's only water to prove for a few hundred homes.
That's a good point.
There's lots of different ways this flows through. And it's not going to be easy. These decisions are not going to be easy.
Are they're primarily political issues, do you think? I mean, I've been a landowner in California for a long time, and it's a constant day-to-day issue, drought. You're either in or out of drought, mostly in drought, but you've got this huge agricultural need. But then you have people building houses every which way. So it just seems like an incredibly complex agriculture versus other aspects.
Yeah, they're not easy decisions whatsoever, and politics certainly can get involved. I can give a couple of examples of that. Again, outside my remit a little bit, but there was news a couple of days ago, the new governor in Arizona releasing studies that were done under the prior administration that hadn't been released. I will give another one about these trade-offs over the summer in Mexico. and this has been a long-running thing off and on. AMLO was really focused on water stress in the north, where there happened to be a lot of beverage companies. There was one factory years ago that was partially built that was abandoned because he was really trying to encourage and force the production to move down south where there's more water. And it's not a good look if you're a big company and your product's being produced, but literally the citizens don't have access to water, and that was happening, which makes it interesting, again, bringing in, that these things are certainly trade-offs between growth and other things. A few more examples. Tesla announced they're going to build a factory in Mexico, and that's actually just in that same region of Mexico where they're not letting beverage manufacturers anymore. And they've already had issues getting a permit to expand in Berlin because of water issues. So
really interesting. Gail, thanks a lot. Really appreciate it. Gail Glazerman, Bloomberg Intelligence Senior ESG Integration Analyst.
Coming up on the program, is Apple the clear favorite of Gen Z? We'll answer that question next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Apple was the clear winner in Bloomberg Intelligence's most recent smartphone survey, with 79% of Gen Z consumers preferring it over competitors. For more on this, we're joined by Bloomberg Intelligence Senior Technology Analyst Anurag Rana. Hey, Anurag, can you just define for me in your survey, what is Gen Z, by the way?
Oh, I didn't even know that. We ran it.
The young people.
Young people, very young people for me. But, the fun part was when we run a survey every year of the entire population in the U.S. That's people between, 18 and 85. And we found out that 47% of the people liked Apple in that survey. And when we look at market share from IDC has about 41% market share for Apple in the U.S. Now, that's very high compared to global market share because people in the U.S. buy a little more expensive phones than the rest of the world. But, what I found out was, as I was looking around me when really young people, 16-year-old, 17-year-old, and I was asking them, how many of their friends are using Samsung versus Apple, overwhelmingly, I was hearing that, 90% of the people are using an Apple product. And I said, well, that doesn't jive well with the market share that I have. So that's when we did this survey that was only for 18 to 24 years old. And as I suspected, overwhelmingly people are Apple users. Now, this basically shows me is when these people get older over time, they will stick to the brand. You don't really go switch between ecosystems. So from that point, I think in the long term, people normally say that U.S. is not a growth market for Apple, and we disagree with that. I think Apple will still continue to grow nicely in the smartphone world in the U.S.
Why do you think it's appealing to the younger generation?
I think it is a coolness factor.
Still, there's the coolness factor. Paul and I have iPhones. We're not cool.
We're not cool.
Yeah.
No, I agree. But I would say, I would, well, same here. But I would, you would not believe it is sometimes something as silly as the color of the chat that you have with people. If you are a lot of young kids and somebody has a phone that is not an iOS, they are really looked down upon. It's actually sounds so stupid, but I've heard that, multiple times. Apple is creating an ecosystem of young users. It treats privacy very well. It's very conscious about the quality of the products it launches. Sometimes it's very late to launch a product because it wants to get it right. But once you get that product, it's very difficult to go back to a different product.
Are Gen Z folks keeping their phones longer? Because it seems there was back in the day, we were upgrading almost on a yearly or every 2-year basis. But, man, I never do it anymore.
That's fair, but, you are probably, on the other side of the spectrum. I, for example, will upgrade it every 2 years because I want to see what's happening. But at an average, currently, globally, the average refresh cycle for an iPhone is somewhere around 3.6 years. And what we found in our survey was both for the overall population of the U.S. and the Gen Z population, that's pretty much consistent. So that they haven't changed that, which means, the refresh cycle remains the same. The big thing that we found different was that they are very much focused on the camera quality compared to the price. Now, that's another good thing for Apple because that means that as they buy more phones down the road, they're going to most likely choose the more expensive option, which is the Pro model, and much, more cheaper, much better than the cheaper SE model. So, volumes go up and then the price goes up. That's really good news for Apple.
Is it the same way in other countries?
It is, again, camera quality is important. But
aside from camera quality, are the younger generations in other countries Apple fans?
They are Apple fans, but, one of the things that we don't have a quantification of it because, this was our first survey in the U.S. We will try to replicate this in other geographies as well and see how they shape up. But I would argue, for example, in South Korea, it's overwhelming Samsung. Mm-hmm. So that's not going to be the case for Apple. But I think UK and Western Europe most likely is going to be an Apple family, I would say, more than anything else.
And Anurag, how important do you think just kind of the suite of products is? I think about the Apple iWatch, the AirPods, which, by the way, I cannot keep in my ear. They always fall out, so I'm not sure if I'm doing something wrong. But is that important to the young folks?
It is the single most important thing for Apple's growth story going forward. I mean, it is extremely important because once you get hooked into one product, you're going to buy more things. We saw that among this cohort of people, 62% of them had AirPods. That's a very big number, frankly. Compared to the overall cohort of about 47%. Now, what will happen down the road? And the way I model Apple's financials is I look at the iPhone as the base. There are about 825 million people or iPhones around the world. Then you have to see, what is the attach rate of the watch, which is currently under 20%. What is the attach rate of AirPods? That's probably in the 30s at this point. So you have to guess that, in 10 years from now, or you have to model it out, what would that be? Apple Watch, I think, is going to be a very interesting thing, especially if we get more health features in it, because I think that number from 20% attach rate could go up to 50, 60 one day. That would be part and parcel of what you do on a normal basis because it's giving you so much more than just entertainment or, text messages. It is going to help you lead a much more healthier life, and I think that becomes a very big product for them down the road.
Wrap it all together then, because they're early adopters. They like the stuff. They're going to stay in the ecosystem. But are they going to pay over $1,000 for a phone? Will they pay up a serious cash for an Apple Watch?
Yeah, I think that's what this, our survey is saying. They like cameras far more than they like the price by a very big majority. So that tells me
for $1,000, that's not. I just can't imagine being 23 and being like, "Here's my $1,000 phone." My brain explodes.
I agree with you, but Apple has shown that when it launches a product, it focuses more on margin than the market share. So one of the things you have to see, and again, I see this in India all the time. Apple is an aspirational brand for a lot of young people. They start up with a $100 to $200 not iPhone, a smartphone, which is most likely an Android, and over time, as they get more richer, they would pick this over any other brand.
Well, see, that kind of goes to the story I wanted to get to, Anurag. I want to talk emerging markets and Apple, because there was a time a few years ago in one of the product launch cycles that they were going to bring out like a $300 phone, and it was going to target emerging markets, and they were calling out India as a great area of opportunity. Is that still it? Do they still have a product line like that or no?
Well, the iPhone SE, I believe, starts at $329, but I have to check that. I mean, it's not. It's relatively a cheaper phone, but it is not cheap by any standard for the lower end market. I did a piece a year and a half ago saying that if Apple were to reduce that price by, let's say $29, $30, it can gain X amount of market share. I was very excited about it, but then they came out with the brand new phone and they raised the price by $30.
They're like, we'll take your survey and do the opposite.
Yeah, they don't care about that because what they want to do is. Because, those lower end, I would say people who are not at that point able to buy the more expensive product, they start with a used phone. They start with a refurbished phone. They get hooked into the ecosystem, and then they go out and buy the more expensive one when they have the money to do it.
Is this part of the thesis for Apple priced into the stock?
I think a lot of people like Paul think that why do I need to refresh the phone quite a bit? It's a mature story. It's not going to grow as much. What I want to think about is global smartphone markets. Apple market share is still less than 20%.
Really?
it takes time. It is going to take its own time to gain that market share, because as people get richer around the world, and we all hope everybody in the world gets richer around over time, whether it's in China, whether it's in Brazil, Indonesia, and India, Apple will continue to grow. This really, to me, is very much like Coca-Cola's in the 1920s, when it was only an American story for a while and then became a global story.
I still think, Anurag, that they should pay a dividend yield of 3%, but I am in the minority there. All right, thanks to Bloomberg Intelligence Senior Technology Analyst Anurag Rana.
All right, coming up on the program, we're going to get the latest on SVB's balance sheet flexibility.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
I'm Alex Steele. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
So SVB Financial is basically a commercial bank, and it serves emerging growth and middle market growth companies. It's pretty targeted niche, and it's focused on technology and life sciences. It's also based basically in Silicon Valley, so that kind of helps explain it. I want to get a little bit more on this in terms of, say, their balance sheet flexibility, also potentially some losses or liquidity risks with the company. Herman Chan joins us. He is Bloomberg Intelligence Senior Industry Analyst for banks. He joins us now. Okay, Herman, you wrote a whole note on SVB. What's so interesting about SVB?
Yes. So SVB, which stands for Silicon Valley Bank, in a lot of ways, it's a victim of its own success and a victim of circumstance, given the fact that rates are as high as they are today. So SVB caters to startups, as you mentioned before, technology, life sciences companies. So during the height of the pandemic in 2020 and 2021, venture capital activity was gangbusters, record activity in both years. And that activity flowed through into Silicon Valley Bank in the form of deposits. So as these startups raised increasingly larger funding rounds, those funding rounds reached SVB in the form of deposits. And SVB, while it was growing its loan portfolio at a very brisk pace, that loan portfolio growth was not to the same quantum as deposit growth. So SVB had to deploy all of this excess liquidity in a economically feasible fashion, and they did so by investing in securities, so treasuries, asset-backed securities, mortgage-backed securities, and the like. And those securities, as you can imagine today, with interest rates rising, the value of those securities has declined. And so they're sitting on a $15 billion unrealized loss on their held-to-maturities portfolio today. We believe this is less of an issue given the fact that there's very low liquidity risk, but it is something that the market has been focused on.
So you don't write that kind of stuff down, do you? Do you take a provision against it? What do you typically do? This isn't a real estate loan.
Right. So what Silicon Valley can do is they can just write it out and hold these loans, and these loans get paid quarter to quarter, month by month. These securities get paid back quarter to quarter, month by month in the form of coupons. So they can just write it out without any risk to the balance sheet or to the company.
They never have to mark to market it?
No. So they're held to maturity. So the mark to market
just because they're held?
is not. The accounting, there is an accounting issue, but in our view, this is not going to become an economic issue for the bank.
All right. So what is the economic outlook for SVB in terms of their clients? I mean, with interest rates higher, venture capital gets a lot tougher. Getting deals done becomes a lot tougher, a lot more expensive. None of that is a good fundamental support for SVB. What are they saying about it?
Correct. So the backdrop has affected SVB in the form of deposits flowing out of the bank. So given the fact that they are catering to startups aren't really raising additional funds at this point. They're burning through cash. And that means that SVB has seen the deposits decline somewhat. That's 5% year-over-year decline in deposits. So it's something that is an overhang for the stock, and it's affected their earnings power. In the meantime, the company has said that the cash burn levels has dissipated somewhat. So there's hope that over time, the startups will capitulate and institute a down round in funding, meaning that the implied valuation is lower than the previous funding round, just to continue to operate.
I mean, the stock is up, SVB is up 20% year to date. So are investors kind of looking out towards the other end, maybe?
Correct. So the company did have some positive commentary in their fourth quarter call, mentioning the fact that cash burn is slowing a bit, and there's optimism that that could steady deposit levels later on in 2023.
In terms of how the company then winds up growing, though, so it may not get worse. They may have stemmed the loss, but can they grow from here? Like, have they been through a downturn before and come out the other side to grow?
Sure. So the company has been through the ups and downs of Silicon Valley. So you can think about the dot-com bubble as a good example.
So been there, done that.
Right.
Okay.
Correct. So they've been there, done that. They are beholden to the economic cycles of what happens within the VC community. So remember, there's still a ton of dry powder on the sidelines that needs to be deployed over time. So once there's a bit more clarity on the overall economy and interest rates, you could see venture capital deployment pick up, and that would be helpful for SVB.
All right, Herman, while we got here, let's just talk about your regional bank coverage in general. What's the number one issue that your institutional investors or clients want to talk about in a world where money's not free anymore?
That's right. So the question is, what happens with interest rates? Earlier in the year, folks were talking about potential cuts in the back half of 2023. I think that notion is out the window. We think interest rates are going to be higher for longer, and that has implications for regional banks. It has potential for a harder landing, which means higher credit losses for the regionals. It also means that implications for net interest margins and what happens with deposit costs, which are rapidly increasing for the industry. So a lot of uncertainty, a lot of headwinds, and a lot of headwinds on the loan growth front too, with higher interest rates meaning potentially lower economic activity, therefore lower loan growth.
When are you hearing regional banks think we're going to see the bottom, the max uncertainty moment?
The max uncertainty moment. That's a good question. It really depends on when the Fed gives more clarity on the pause in interest rate hikes. So if that comes later this year, that would be a welcome development for the banks.
So basically, no visibility, just like everybody else. Herman, thanks a lot. Herman Chan, Bloomberg Intelligence Senior U.S. Regional Banks Analyst.
All right, let's turn now to Europe's lukewarm 4Q results, where the number of companies beating expectations is the lowest since 2020. For more, let's welcome Bloomberg Intelligence Senior Equity Strategist Laurent Douillet. Laurent, thank you so much for joining us here. Talk to us about the fourth quarter results coming out of Europe. What are your big takeaways?
I think there are three main takeaways. As you have mentioned, overall, European companies have shown more resilience in terms of earnings compared to what was expected, and that despite a difficult economic backdrop. And numbers are coming slightly on top, with 53% of companies beating analyst estimates. EPS growth for the quarter about 13% year-on-year compared to initial expectation of about 11%. The major drivers of the upside surprise are mainly the banks, technology, and healthcare. Second interesting point is that we have seen a turn for the best for EPS revisions for 2023 after 4 months of downgrades. And it seems that this trend of earnings upgrades is quite broad-based. So it seems that the company guidance is quite solid for 2023, maybe also compared to low expectation from the sell side. And the last point I will mention is definitely more share buyback announcements compared to what was initially expected. We knew that the banks and the oil and gas companies, given the strength of their cash flow, would announce additional share buyback. But we have seen also announcement in healthcare and consumer discretionary, and that I think was taken pleasantly well by the market.
Okay, a lot to unpack there. Let's go to financials for a moment. What are CEOs talking about when it comes to their outlook then, and what's priced?
If you look at the guidance of most of the European banks, they have been quite optimistic about their net interest income. So it seems that at this point, the market is not yet discounting 4% ECB peak rate in 2023. So potentially, I think there's still some potential upside for the bank revenues for this year. Regarding the recession, it's true that potentially if the ECB is too hawkish, it could bring the European economy into a recession. So I think here there are already some expectations that potentially it's going to be a much more difficult trading conditions for banks. So when you look at the valuation, it's true that banks have somewhat re-rated over the past few months, but I think at current valuation, there is still potentially some upside in that segment.
So, Laurent, here in the U.S., I think the most recent quarter can be characterized as some revenue growth, kind of, low to mid-single digits on the sales growth, but declines in profitability. So the margin story, the margin compression, still an issue for U.S. companies. Is that the same case for European ones as well?
Yes. In fact, if you look for the MSCI Europe, in the fourth quarter, we estimate that the margin pressure was about 66 basis points compared to last year. The only sectors or segments which showed some positive comparison are mainly the ones which show very strong top-line growth. So it would be energies, auto, luxury goods, and also healthcare companies. If you look at all the other European segments, then you have some margin compression going from 50 basis points to up to 600 basis points compared to last year. So I think it's definitely a theme again for 2023. Potentially the risk to the margin this year is not going to be about material cost because the price of gas has come back quite significantly in Europe. Also, for the moment, oil price is not going anywhere. So the year-on-year comparison for materials is going to be okay for most of the European companies. But I think one of the issues is going to be wage inflation. We are now at levels that we haven't seen for several decades in Europe, and potentially some companies are going to be taken off guard by this wage inflation. And so I think this is where potentially is the risk to margin in 2023.
Right, which then if you get a slowdown in the economy, then your top line kind of gets hurt, and then you get squeezed on both ends in essence.
Yeah, exactly. Because if the economy gets into a recession, it would be very difficult for those companies to offset the wage inflation by higher prices. So definitely there will be a squeeze here.
What are we seeing just overall in the market in terms of earnings expectations? We talked to Gina Martin Adams here in the U.S. and about those expectations, and they are coming down for the S&P 500. Are analysts taking down their estimates? And if so, are they doing it enough, do you think, in Europe?
No, for the moment, in fact, since the start of the reporting season, let's say since mid-January, in fact, we have seen a turn in terms of earnings revision in Europe. So we have seen more upgrades compared to downgrades. It's quite broad-based. It's not just happening in banks or in energy. So I would say that's definitely a divergence compared to what you can see in the U.S. And potentially it could explain potentially one of the reasons why European equity indexes have done better than their U.S. counterparts. I think when I look at my macroeconomic model, I still think the market may be too optimistic for these years in terms of earnings estimates, because if you exclude energy and materials, which are well known going to see some earnings decline, in fact, the anticipation for the Stock 600, excluding those two sectors, is for EPS growth of about 8%. So given what we just discussed about potential margin pressure, also potentially if the economy goes into a recession, I think it's going to be difficult for the overall index to deliver such high level of earning growth. So personally, I still think potentially earnings estimates are too high for the moment.
Yeah, but then it's like our equity price is still going to go higher because where else are you going to put your money if it's moving out of the U.S. in essence? We've got to leave it there, Laurent, but thank you very much, Laurent Douillet, Bloomberg Intelligence Senior Equity Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.